think what's really notable, and there's been some confusion, in various corners of the internet about this, is how resilient those flows have been and how disproportionately long-term buy and hold fundamental type investors we've seen in these products. You take, Bitcoin and IBIT, for instance. Bitcoin down, almost 50%, obviously from its all-time high that it made in October. The flows in IBIT on a year-to-date basis are actually slightly positive. So there's been a lot of selling pressure elsewhere in the Bitcoin ecosystem, on crypto exchanges, on these offshore levered perps platforms. But the ETF investor base has taken a much steadier, longer-term fundamental view of things. The retail contingent actually are some of the most long-term focused that we've seen, and they've tended to opportunistically buy the dips. Kind of 90+% of the investor base, whether we're talking about retail direct investors, we're talking about financial advisors, talking about other institutional investors, have tended to be very steady and have been on an accumulation path pretty consistently. If you look at 2025, the number of the top inflowing ETFs in the world that had negative price return, the top 20, there was only one, which was IBIT. So despite negative price moves in Bitcoin, IBIT was fourth in the world in inflows with 26 billion in. So we've just seen that steady accumulation pattern on a long-term basis.